Hi everyone, welcome back to Stephan podcast, brought to you by Bold. For American listeners, go to getbold.io to buy Bitcoin over there. Now, rejoining me on the show is one of my longest time friends in Bitcoin, Pierre Rochard. He is the VP of Research at Riot, and also well known for his commentary and his work with the Nakamoto Institute. Pierre, welcome back to the show.
Thanks for having me back on, Stephan. Happy to be here.
So Pierre, I am really looking forward to chatting with you today because I think this is a theme that seems to be coming up now, and it's something I know you've been talking a bit about, which is, I guess, I'm not sure the best way to frame it, but maybe securitization versus tokenization, right? So it's kind of like, are people going to just, and I guess one way to think about it is like, are people going to use kind of on-chain crypto DeFi things, or are they just going to use TradFi to get their Bitcoin exposure? So I guess that's kind of the headline idea. Do you want to just spell out some of your thoughts? I know this is something you've been thinking about a lot.
Yeah, absolutely. I've been thinking about it really my whole career because I started out my career in securitization. So it's a topic that I have a strong bias about, obviously, and that I've also seen over the past decade of researching Bitcoin and the wider crypto sphere. I've definitely seen some trends and some things that have worked out and some things that have not. So I think that first, to set the table, we have to look at, I also have a product background, and in product, we're always talking about what are the users saying? What are the problems that the users are facing? And then let's build products around that. So when you look at the survey data of people who are not Bitcoiners, and you ask them about Bitcoin and what they think about it and why they are not buying it, or, what the stumbling blocks are for them. Historically, the number one has been the regulatory uncertainty. And so people have always worried about, is the government going to ban it? Is it just for criminals, etc.? Even, you look at Michael Saylor's famous first tweet about Bitcoin where he was skeptical about it. It was exactly along these lines, that there's too much regulatory risk around it. Now, if we look at how Bitcoin fared under what I think was the most unfriendly administration towards Bitcoin, the Biden administration, they'd never really got around to banning Bitcoin or effectively acting against it. If we look globally, there are jurisdictions where it probably is harder to openly be a Bitcoiner, maybe in China, so countries that are totalitarian, dictatorial, communist, definitely challenges there that still exist from the regulatory lens. Although you occasionally hear rumors about them opening up. So I don't speak Chinese, so I don't know how true those are. We'll let our Chinese audience mail in their views on
their feedback
the situation
in
China. But now that Trump's president here in the United States, I think that the regulatory question is no longer number one for a variety of reasons. Obviously, at the Bitcoin conference in Nashville, Trump gave a very forceful speech establishing his pro-Bitcoin position, which was a big change compared to his previous position, during his previous administration, where he was more of a Bitcoin skeptic. And at the time, Treasury Secretary Mnuchin, on his way out, kind of tried to sneak by some anti-Bitcoin regulations, which failed, but really showed that things have changed even between the Trump administrations. His cabinet, which is for the most part confirmed at this point, is just filled with people who have a track record of saying pro-Bitcoin things, disclosing that they own Bitcoin, right? So clearly, I think that the regulatory risk has become minimal here in the United States. And of course, when we look at what's the number two objection, is the volatility. So people look at the Bitcoin price, and this is something that the mainstream media reports on constantly. They in fact, sometimes they only report on Bitcoin when the price is volatile, right? Either it's going up a lot, it's going down a lot. And I think that this objection about Bitcoin is one that historically the Bitcoin community has had a very hard time being empathetic towards.
Right, it's seen as like just man up and huddle and that kind of thing.
Yeah, or have fun staying poor, and it's. And I think that one of the reasons that we don't have the empathy that we should have, the public Bitcoin discourse all too often is dominated by young men who kind of have that pro-risk attitude of, just outside of Bitcoin, right? Just put Bitcoin aside, young men just have too much testosterone and take on too much risk, right? Relative to perhaps what society expects from responsible adults. So that's been to the benefit of the people who have a strong ability and willingness to take on risk because it's come with very high returns, right? And so that's the second part where I think that we lack empathy is, okay, well, sure, high volatility, but take a look at, don't you want to have 10x gains, compare it to your boring bonds and stocks? Yeah, you don't have a lot of volatility, but you also just don't have a lot of upside. And so I think that this is now the number one problem for Bitcoin adoption. It's not regulatory uncertainty anymore. Now it's price volatility. And now we need to think about, okay, how are we going to address that? We fixed the regulatory risk by lobbying, right? By engaging with candidate Trump and orange pilling him and, orange pilling people around him. So it's not like we are victims of history and we kind of just have to let things play out. No, we have to be actively involved in shaping the future of Bitcoin in order to accelerate adoption and bring on more Bitcoiners. I think that the other part that really bothers Bitcoiners with regards to volatility is the conversation around the technology versus number go up, right? So the hardcore cypherpunk ethos of, let's just write code. We don't care about the Bitcoin price. 1 Bitcoin equals 1 Bitcoin. I think that there's really a ceiling to how many people are adopting that ethos, which is really an ideological one. And so in order to break through into the mainstream, I don't think that perspective on its own, because I think it's a really important perspective to have, right? Obviously, I share it, but I don't think that it's a complete perspective on how Bitcoin can fulfill its full potential. And so this is another area where, because of our emphasis, for example, not your keys, not your Bitcoin, right? So completely understandable where we're coming from on that you look at Mt. Gox, you look at FTX, you look at all the tragic, outcomes of trusting a third party with your keys, and then just the software engineering reality that indeed, if they're not your keys, they're not, you don't hold a UTXO, you don't have a BTC, you have a IOU, you've got to trust me, bro. And so that also, I think, shapes the conversation around volatility, where if you're holding raw, real Bitcoin, you have to accept the volatility. It's part of the package of Bitcoin. And so then it's just, okay, well, you don't understand freedom technology if you are not willing to see an 80% loss in your portfolio, which, I mean, yeah, sure, that's true, but that's not going to persuade anyone, right? People are just going to go move on to the next thing. They'll go on Robinhood. They'll go trade something else. So that's where I think that what we've seen with regards to the financialization of Bitcoin over the past, I'd say really since the launch of the ETFs, right, over the past 18 months, a rapid acceleration of the financialization of Bitcoin. It's not entirely new. We had GBTC before, but the SEC was not just keeping a lid on altcoin Scambrian explosion, right? They were also keeping a lid on the development of securities that were backed by Bitcoin. The Winklevi twins tried to launch an ETF in 2014. So it's been a decade of the SEC saying no to the financialization of Bitcoin. That's a double-edged sword. The cypherpunks will say, hey, that's a good thing. That helped push people towards holding their own keys and actually using Bitcoin. My perspective is that was a disastrous thing. It pushed people into the crypto casinos, whether onshore or offshore, like FTX. I think that it had lots of second-order effects that were very negative for the financial outcomes of people, right? So it's kind of like, is it better to have a purity test where somebody gets scammed into owning Solana or something, because they couldn't access an ETF? Or is it better for them to just get the financial returns of Bitcoin, the NGU part of it, without having any kind of understanding of what a Bitcoin address is, right? And I think that's a valid debate to have among Bitcoiners. But it's also, I think, something we can look at the market and see that I think the debate's over from a market perspective, and that there's lots of people who just want to hold an ETF in a portfolio. Now, to steelman like the other side of this, it does present a huge amount of legal and jurisdictional risk for the people who are holding the ETF. So I think that the strongest argument for holding your own keys is, in particular, if you're in a low trust jurisdiction, right, where you don't have any semblance of rule of law, the courts are completely crooked, you don't have property rights, the government will just steal everything you have, all the time. And now, where you put the United States on that scale, okay, we could have subjective different views on the jurisdictional risk of holding an ETF here in the US. Personally, my read of it is that it's kind of on the low risk side of things. And that, especially if you compare it to, for example, holding Bitcoin at Coinbase. I think holding Bitcoin in an ETF product is lower risk than holding Bitcoin in your Coinbase account, with the caveat that you don't have the ability to withdraw to your own keys yet. That's something else that the SEC has been blocking, which is what's called an in-kind creation and redemption. Yeah. I think eventually you'll be able to convert your Bitcoin into an ETF and your ETF into Bitcoin on-chain. So there's just a huge amount of user experience improvements that will come along the way. I'll pause here. Yeah. I've got lots more to say.
Let me try and summarize a few of the thoughts. Yeah, because there was a lot there. So I would summarize what you were saying as, in the earlier years, there was this regulatory concern of Bitcoin, right? Is it going to get banned? Is the government going to try to regulate it into the grave? We don't know. Now, it's fair to say now that is very, very low risk, at least in the US. Secondly, the other big aspect is the volatility. So that's the element where we've essentially, in some sense, Bitcoin has selected for those individuals with a high risk tolerance. And that tends to be young men, right? And I guess even you and I, when we first got into this, 12, 13 years ago, whatever, we were young men. So we kind of had higher risk tolerance then, right? So I guess you could sort of argue that that point. But I guess bringing it back to this kind of, is it going to be securitization or tokenization? And I guess there's a little bit of a debate, some discussion online about what's the path forward. Is it going to be all these kind of L2s and all these, Bitcoin L2s or even shitcoin things that, are people going to be using like crypto DeFi to sort of get their exposure to Bitcoin? Or is it actually just that, wait a minute, there's all this money in the TradFi system, right? Because remember, who holds most of the wealth in the current fiat system? It's boomers, right? Like just statistically, objectively, they hold most of the wealth. And most of that wealth is on TradFi, typical, brokerage platforms, and maybe it's physical property if they have real estate. It's stocks and bonds and property. That's most of the world's wealth right now. So I guess maybe that's where some of the debate is, or discussion is, which pathway is going to bring more people into our Bitcoin ecosystem. And so as I'm reading from you there, it's like part of what you're thinking is that actually there's going to be a lot of people who are coming in on the TradFi side. Not necessarily in the kind of crypto, shitcoin, DeFi, casino, not maybe some, but mainly from the TradFi world. So I guess, would you say that's kind of a fair summary of, would you amend any of that there?
No, I wouldn't. I would just add, I think you set the table really well. I would add one element to it, which is that there's, on one hand, you have people who think Bitcoin's too volatile. On the other hand, you have people who want to outperform Bitcoin. They want to take on more risk and more volatility to get higher returns than spot Bitcoin. And historically, what they've gone after is this world of altcoins, these less liquid tokens that are using a lot of the same underlying technology, but obviously have different token economics than Bitcoin does, and are, a lot of them are pump and dumps, where by taking on additional risk, this person's able to temporarily outperform Bitcoin. And then it's a game of musical chairs of who can get out and realize those gains. So in traditional finance, when you have a situation like this of some investors want less risk, some want more risk, some want, less volatility, lower return, others want more volatility, higher return, you have to develop products that carve up that risk return profile for those two different demographics. And if we look at different ways of doing that, it comes down to equity versus debt. Equity is higher risk, higher return. Debt is lower risk, lower return, right? And so that's why traditional finance talks about stocks and bonds in a portfolio. If you you can look at this at any level, right? Of whether it's a retail brokerage, financial advisor and personal finance level, or at an institutional portfolio level. Every financial institution is just going to have two big segments, the fixed income and the equity part. Now, of course, on the equity part, you can go further out with derivatives and options and futures and really, magnify that risk appetite. But that's where I think that when we look at, okay, so that's conceptually what needs to happen in order to bring in the next big wave of capital into Bitcoin, is that the risk return profile needs to be cracked into those two separate demographics. Otherwise, I think that there's not a huge pool of capital that is interested in spot Bitcoin. The reason we know that is because they're already invested in spot Bitcoin, right? Everybody already knows about Bitcoin. There's no, if you'd have to be living on some remote island without access to the internet to not know about Bitcoin. So I think that the demand for pure spot Bitcoin, it might increase like 4% a year or something, right? But what the massive pools of capital are waiting for is the ability to either access higher returns or lower volatility. So in what format does that take shape? In what format do those products happen? And I think that gets to the key question that you posed is, do those products become SEC regulated securities that have, the legal system, legal contracts around them? Or are they automated DeFi smart contracts that are on chain, whether it's Bitcoin discrete log contracts with oracles, or if it's Ethereum or Solana? Let's set that question aside first of all, and just look at it of where is this activity, where has it been taking place, and where will it take place? So I would argue that it has almost all been taking place on the security side of TradFi with regards to Bitcoin. There have been a lot of trading activity. And okay, now I want to also talk about the fact that, you look at Kraken and some of the other crypto exchanges, they've had leverage trading as well, right? BitMEX famously, you can go 100x leverage. So there's been centralized financial players that have been playing this in this area for a very long time. And even, you go to Unchained Capital, you can borrow against your Bitcoin. So I think that the centralized solutions have really been much bigger, whether they're crypto native or TradFi, than the decentralized or pseudo decentralized solutions that are on chain. So, just putting that in place. Now, why is that? Right? That's a valid question. I think that the on-chain solutions, what it comes down to is regulatory arbitrage. That they can do more things without being slapped on the wrist or sued by regulators than the centralized players can. So if we remove the regulatory risk, right, which was kind of the number one we were talking about there,
Yep.
Or even if it's just a low risk, like I think that realistically it was a low risk in the past, and that's why we saw the flourishing of some of these platforms. Now, some of it had to happen offshore, right? BitMEX offshore, FTX offshore, etc. But I think that it's going to come onshore in the United States. It's going to be centralized. And that all of the on-chain stuff, it really appeals to like a subset niche of the degens who I think a lot of it comes down to just, and I'm not dragging them in the mud on this, but tax evasion, right? They don't want a 1099 to be filed with the IRS. They want to just, degen out on chain and have a pseudonymous permanent paper trail of their activity, but they don't want their social security number attached to it. Okay, that's fine. That's just not going to be a mainstream product from my perspective, and it has not been a mainstream product. So when we look at on the other side, on the centralized side, we've seen obviously, the exchanges, the crypto exchanges, that has appealed to a large audience of people who made a lot of money off of spot Bitcoin, and then, essentially got addicted to gambling, right? In some sense. Now, I also think that outside of the crypto exchanges, when we look at what MicroStrategy has been doing, let's, rebrand it to Strategy. It's going to take a while. I still call it Twitter, right? I don't really call it X, but try calling it Strategy. They've taken the approach of really embracing the TradFi platforms. That is to say that the stock is traded on normal exchanges. You can log on to Robinhood or E-Trade or not Vanguard, probably, TD, Schwab, whatever. Buy shares of MicroStrategy. And then on the bond side, so this is where they take on a little bit of leverage and appeal to a different investor audience that has a different risk appetite than spot Bitcoin and a different appetite than MicroStrategy shares. And they've done private placements of these convertible bonds. And so this is all just completely off chain, right? I believe, they use Coinbase as their custody solution. So it's all just SQL databases and legal contracts, but it's billions of dollars worth of Bitcoin that are essentially moving around off chain. And this is, what Michael Saylor refers to as the capital, the Bitcoin capital with an A, that is driving his treasury strategy. So, and of course, Riot, my employer, we've also done a convertible bond. Marathon has as well. We've seen lots of companies pursuing this strategy.
Semler Scientific, others.
Yeah. With different flavors, right? Everyone's got a slightly different approach, but the end result is accessing pools of TradFi fiat capital and bringing them into the Bitcoin ecosystem by meeting them where they're at. And I think that for Bitcoiners who've been around for a while, the immediate instinct is, well, this is going to end poorly because they're going to get rugged because Coinbase is going to be seized by the government. So it always goes back to like the regulatory risk aspect of it. And when we take that off the table, and I'll tell you what, these TradFi investors, they don't think that the federal government is going to seize financial assets. If they did, they would not be TradFi investors. They would be exiting all markets and going all in on spot Bitcoin in cold storage and gold and whatever else. So I think that for Bitcoiners who have the libertarian ethos / paranoia, which, and I remember Saylor got in trouble for saying this.
Right,
he
calling
was like,
people paranoid crypto anarchists. Yeah. And in fairness, it's like he adjusts his message for the audience or the person he's talking to. So,
I also don't think he was wrong. Like, people were dragging him for it. I'm like, yeah, I'll sign up for that. I am paranoid. Part of me is very optimistic and hopeful and thinks, everything's going to work out really well. So two things can be true at the same time, right? That's how you manage risk.
Fair enough. Yeah.
So that's where I think that there's this strong dichotomy in particular around the narratives, which is that over the past decade, the altcoiners, the crypto VCs, all of this establishment has been pushing a narrative that we're going to see the tokenization of real world assets. Okay, what does that mean? Tokenization of real world assets. I think that you could use a very simple example. Let's say Apple, right? The corporation, Apple. We're going to take Apple shares, right? AAPL, that is traded on NASDAQ, and we're going to tokenize it by putting it on a blockchain where each token is backed 1-for-1 with a share of Apple. Now, does that mean that any value has been created? No, none at all, because all you did was just change the form of the value. You didn't actually create any value. You just moved it, right? So it's like saying, okay, I have a pizza here. I'm putting the pizza inside of a box. Do I have more pizza now that it's inside of a box? No, you don't. You're just transporting it. And I think that this causes a lot of cognitive dissonance for the tokenizers, because they'll say, oh, tokenizing equities, that's $1 trillion opportunity. No, it's a $0 opportunity. Okay. You're just changing the form of the asset. You're not creating new value, new wealth, new assets, right? So that's first thing first. Then they fall back on, well, okay, sure. What about if Apple issued a token which was just not backed by shares of Apple, not backed by, like, it's not like a gift card, like you can't
right,
buy.
So it's not gift,
Apple
not
things.
debt, not equity, like just a free floating token.
Just, it's part of the Apple ecosystem. It's
you need to use these tokens to use your iPhone.
Yeah, it'll have utility in the future. In the future, you'll have to use the token to use your iPhone. Not today, because that would inconvenience everyone, and then Apple would lose market share and everybody would switch over to Android. But at some point in the future, right, there's a promise of it'll be part of the Apple community, right? We'll have good vibes from the token, and that's why you should buy it today and bid it up. And, like, that's what XRP is. That's what a lot of these tokens that exist today. And that's kind of their vision, that every corporation will have some kind of token that isn't concretely promising anything today, but by vague brand association might have some kind of benefits at some point in the future. Okay, take the meme coins, for example, because there's no difference between what I'm describing and meme coins, right? The only difference is what the meme is. So, there's the Apple meme, there's the XRP banking meme, there's the Trump meme of, I saw David Sachs on camera. He was saying the Trump coin is just it's like a commemorative coin that you could go buy it at a gift shop. It's just commemorating the fact that Trump is president. It's not actually backed by anything. There's no promises associated with it in any way. It's just out there, and people can buy it and sell it, and that's fine. And then you have Dave Portnoy with Barstool Sports. He's going out talking about different kinds of meme coins, seeing them pump, seeing them dump. So I think that tokenization narrative, that's what it regresses to. It starts out as, we're going to tokenize real world assets. So we're going to put real estate on the blockchain. And then they realize nobody actually wants to do that. It's a lot easier for investors for you to securitize your real estate and to put it, in a trust and have legal contracts around it that everybody is familiar with doing due diligence on. And it's just not even that hard to do. It's less expensive than tokenizing. And then they fall back on, okay, we'll just do dog-related meme coins, right? So,
right. Yeah. And I guess I'll just add here as well, in crypto world, like to add to your point, there's this sort of, like, they have these ecosystems where they talk about, like, oh, we have like a DAO and we vote about it, right? So you get this token and you get a vote in the DAO, the decentralized autonomous organization, and they kind of have these sort of Rube Goldberg machines, and this is all part of the, let's say, the tokenization aspect of it, as contrasted with the securitization and financialization, I would say.
Yeah, that's right. Let's look at the most famous DAO, which was on Ethereum, that caused their hard fork, and I forget what Vitalik called it. I think he called it an irregular state change.
Back to the show in a moment. This show brought to you by CoinKite.com, the creators of the best Bitcoin hardware security devices, such as the Cold Card Mark IV and the new Cold Card Q. Now, we use Bitcoin hardware security devices to keep our keys offline, our private keys offline. Now, the way these work is you can do that setup, write down your 12 or 24 words on the seed word cards, and keep that secure. Now, you can use this device to interact with the Bitcoin network using software such as Sparrow Wallet, Electrum, or Vector Desktop, or Nunchuck, as a few examples. Now, you have a range of security features that you can use with these devices, such as passphrases, you can use seed XOR, or my favorite is multi-signature. Now, if you're starting in a basic way, just start with the device and the USB-C cable, plug it directly to the computer and use it that way, and then later improve your setup. But I believe these devices are great at helping secure your coins, especially as you start to migrate up into multi-signature security. But don't be disheartened or don't be scared away. They are accessible, and I think you actually do learn about Bitcoin in the process. So to get yours, go to coinkite.com, use code Livera to get a discount on your cold card. This episode brought to you by Galoy. They are building banking software for the Bitcoin age. So if you are with a bank, a fintech, or a startup looking to offer some kind of Bitcoin product, whether that is a Bitcoin collateralized loan, deposit accounts, or payments, Galoy can help you. Their latest product is called Lana. It is a loans management platform, and you can use this to come to market quickly and offer a loans or Bitcoin collateralized lending product for your customers. Now, Galoy have a lot of experience in the space. They started with Blink Wallet in 2020, and they've since grown this to become a community favorite over time. And so they have a lot of experience making things work in a secure, reliable, and scalable way. So if you need assistance coming to market quickly with a Bitcoin banking product, such as lending or deposits or payments, talk to the team at Galoy. You can email them. The email is biz@galoy.io, or go to the website galoy.io. And now back to the show. Right, because they very much hate when you call it a rollback, right? They want to say, no, we just amended this particular balance or transaction. We didn't roll back the whole chain. That's their kind of argument, I guess.
And the premise of that DAO was that they were financing a startup called Slockit. And with Slockit, you would have a real world lock, right? Normally you would use a physical key to unlock your house. but it would be digitized, and you would be able to use your Ethereum private key to unlock your house. And so, what a great investment to participate in as a VC. Totally plausible business idea, right? Sure, why not? Yeah, okay. Now, is that going to outperform Bitcoin? Probably not. Is it like does it benefit in any way from being on chain as a DAO in terms of financing the enterprise? No. In fact, the opposite is true. It was a liability. It was a disbenefit to be on chain because the contract got hacked. So it would have been much better if it had been written down on paper, because then what would have happened if it had been written down on paper? Well, let's say the hacker saw the bug in the paper contract. Well, what does he do with that? He goes to he sues them in court, right? He says, hey, I found a bug in their contract. It says here I can take all the money. The judge looks at it and is like, well, that's just a typo. You're an idiot for suing over this. I'm throwing this out as a frivolous lawsuit. Go away. You're obnoxious. Okay, that would have been the end of it. And so it really would have been better if that contract had not been on chain. They would not have needed a regular state change. Instead, a judge would have laughed at the stupid hackers, pointing out a typo in a contract that obviously was not the intent of the contract to give them all the money. And so that's where I think the crypto space really fell into a trap of trying to find problems to solve and being naive about it rather than kind of being more realistic about how the real world operates.
Right.
Now, let's say that a company did actually succeed, right, with launching their product and making lots of money. Would the investors have a higher return if it's a DAO versus whether it's just a normal startup equity? No, it'd be the same return, right? It's the same outcome. It's just taking on additional risk on something that's not even related to the product that you're building.
Right, I think it's unrelated to the business risk. It's just like using a different database technology, right? If you use MySQL or PostgreSQL or something like that.
Yeah, or something that you just made up in-house.
MongoDB or some other database, Yeah.
So that's where I think the DAO narrative, I mean, it fell apart like right out of the gate. And all we've seen is with these DAOs or whatever it is that they just end up like launching another blockchain and just finding more narratives to grift off of rather than actually creating any real world value.
Yeah. Okay, so look, let's summarize some of the key things. So as you said, it's that regulatory concern and then the volatility. And now, as an example, Michael Saylor with Strategy and other companies, they can sort of offer specific financial products that exist. And for people who really want more leverage, like obviously we think of it, at least the way I'm seeing it, is Bitcoin is our savings. But if you want to invest, right, you're trying to earn BTC yield, that's where a person may choose to invest in some kind of Bitcoin treasury company or some kind of strategy where they are trying to outperform Bitcoin and earn more in Bitcoin terms. Or even in the other case, it may be that you can't handle the full volatility of Bitcoin, so you just want something that gives you a bit less than that, but maybe it's a bit safer or a bit lower risk or a bit less downside, different aspects to that. I think, and I'm with you there. I think the other important thing is just fundamentally that most of the money in the world is already on the traditional TradFi platforms and rails. So it's unusual to think that somehow, because part of the problem or the challenge with the crypto DeFi tokenizer kind of worldview is how are you going to get that money out of these traditional platforms into your little DeFi world?
Yeah, and if you put on your financial institution hat and you look at what DeFi is, it's a back office technology, right? You're saying, oh, we're going to have a different settlement system than we've been using in the past. it's not, it's just completely uninteresting, and it's just additional risk. Now, when you look at Bitcoin, that's a front office technology of saying we're going to use a completely different kind of capital. And that if you look at where these portfolio managers are, they don't have a mandate to invest in commodities, right? So they might think, okay, look, I think Bitcoin's great. I think that it's going to perform well over the next 30 years or even over the next 10 years. And that I'd love to have it as part of my portfolio, but I manage a fixed income portfolio.
Right.
I can't go buy a commodity, even if I think it's going to do great. Even if I size it to be a very small position, so that it's not putting my career at risk or putting the whole company at risk. It's just not something they can access. Now, that's where I think that there's going to be the continued development of Bitcoin securitization, that they're going to want securities that allow them to have exposure to the underlying Bitcoin collateral performance that just doesn't currently exist. And it's going to be driven by a number of different reasons. One, the Trump administration and the Fed are signaling that rates are going to stay the same or go down. And so when rates are, I wouldn't necessarily call them low today, but they're certainly not high, especially from a historical perspective, right? You look back at 1980, rates were high at 20%, right? Today, they're like 4.5%. So now they're not 0% like they were not so long
Correct,
ago.
Yeah.
But nevertheless, there is a challenge for fixed income portfolio managers to get a return that's going to be sufficient to meet, for example, pension plan requirements, right, of people retiring. You've got a whole generation of people who have underfunded liabilities, and they need a way to play catch up. Bitcoin's a great opportunity for that. So I think the low yield, low interest rate environment is going to drive a lot of risk on appetite for exposure to Bitcoin. And then on the other side, on the Bitcoin side, if you look at the history of Bitcoin, it is a story, in fact, of lower volatility and lower return. So Bitcoin's returns have been gradually decreasing over time. I hate to say it, right? Because I'm super bullish on Bitcoin, but that's just what the data shows. And the volatility has been decreasing along with it. Now, to put it into perspective, it's still much greater than any other asset class. So without a doubt in my mind, Bitcoin's going to continue to outperform the broader stock market or bond market, right? There's no doubt. But it is entering an area where it's far more accessible and far less, let's say, speculative, even though, we can argue about that term. In finance, when they talk about speculative, it kind of feels like they're betting at the roulette table when it was Bitcoin in 2011. But what needs to happen is the education of, hey, Bitcoin in 2011 is not Bitcoin in 2025. This asset has very much matured, both quantitatively in terms of the risk return, but also qualitatively. It's just much better software engineering. The questions about, is Bitcoin going to get replaced, flipped? I think any rational person would say that question has been answered conclusively, that Bitcoin's not going to get flipped, despite what, highly regarded people on Twitter might think. So that's where you have an intersection point between TradFi needing higher returns and higher risk, and Bitcoin kind of compressing down to where their needs are. And then it's all about building the right products. There's going to be people who build the wrong products, right? That blow up, that will have too much leverage. Bitcoin is still, has big drawdowns. And so if you use securities to lever up too much and you get wiped out, that's not a good outcome for anyone. So I think that what investors will have to look for is products that are responsible, that are conservative. I would argue that now this is not financial advice or anything, but you look at what Saylor has been doing. He's been keeping his leverage ratio relatively low, so that even during the previous bull market, empirically we can say he did not get liquidated, despite what a lot of critics were saying was going to happen.
During the bear market, but go on, yeah.
Yeah, they said he was going to get wrecked in the bear market. No, he didn't, because he had a very responsible way of structuring his securitization of Bitcoin so that it would survive and then be able to thrive in the bull market. And we saw the results of that with his stock price skyrocketing, after the Trump election. So there's definitely going to be good ways and bad ways of going about pursuing this opportunity. And I think that it's going to continue to evolve. So Saylor started, he's been doing convertible bonds. Now he's doing preferred shares. There's different slices of the capital structure that appeal to different segments of investors, of portfolio managers. So that's just going to be, I think, a huge trend over the next 10 years. There's also, I think, going to be a trend on the sovereign issuer side. You have portfolio managers who can only invest in sovereign debt. So, if you're being creative, and whether it's Besant here in the United States or Bukele in El Salvador or any others, I think that we're going to start seeing not just strategic Bitcoin reserves, but that combined with very creative ways of financing those reserves so that they're able to essentially leverage up and gain access for portfolio managers that can only buy bonds that are guaranteed by the government, but that want to have a taste of those Bitcoin returns, right? That will actually lower the cost of capital for the government, just like it does for a corporation, and unlock other pools of capital. So I think that at every level, it's going to be beneficial. At the individual level, what I think will also happen is that for people who have been using products like Unchained Capital in the past, one of the criticisms, and I don't want to criticize Unchained because they're a great company, but one of the challenges for them and their customers is the high interest rates. 14% on something that is super secure, that's pretty high. A 1-year term, that's pretty short. So as Bitcoin's volatility decreases, as investor confidence in Bitcoin increases, I think the terms on loans will improve. And so Bitcoin-backed loans will start going beyond 1 year and have lower interest rates than they have in the past. And that also has to do with how the banking system approaches Bitcoin. Just today, we saw that chairman, he's got a lot of chairs, Fed Chairman Jay Powell, he was on Capitol Hill testifying. One of the criticisms of the Fed over the past years has been that with the help of the FDIC, they have been locking Bitcoin companies out of the banking system. And part of that is perhaps a good faith concern about the risks involved with Bitcoin. But I think another part of it is that they just don't like Bitcoin from a political perspective. From a policy perspective, they don't like Bitcoin and they want to censor it. This is a form of capital controls where they say, okay, if you're sending if you're sending dollars to an exchange, we're going to lock your bank account because we don't really want you investing in Bitcoin. And if you're a Bitcoin business, we're not going to bank you because we don't want to make it easier for people to be able to buy Bitcoin. And if you're a bank, there's this huge amount of documents that have been coming out of the FDIC because Coinbase sued them with FOIA requests to understand why are there challenges in terms of getting banked. Well, it turns out that there's lots of examples of banks that have tried to get involved with Bitcoin. Okay, why do banks want to get involved with Bitcoin? To make money. They see a business opportunity here, and they see Coinbase making money off of people buying and selling Bitcoin. why shouldn't they have the ability to? Why should you not be able to go to JP Morgan Chase and be able to buy and sell Bitcoin from your checking account? There's no reason other than every time they try to create a product like that, the FDIC would start sending them letters and say, are you sure you want to do that? This is going to cause a lot of complexity as we evaluate your regulatory compliance. This is going to affect your scoring. This is a reputational risk. We don't like this risk. Are you sure you want to do this? And they would do this month after month until the bank would finally say, okay, we get it. You don't want us to do it. All right, we won't do it. And so this was a form of censorship. It's not like there was a law that said that you can't bank Bitcoin or you can't use Bitcoin as a bank. No, it was the regulators that were fabricating objections, and they knew that this was illegal, what they were doing. The reason we know they know is because they were trying to hide it. So they tried to hide it even from the court that was asking for this information. Excuse me. That is all changing, including SOB 121. SOB 121 was this accounting guidance to try to prevent banks from custodying Bitcoin. That's gone as well. The SEC is saying that they're going to be a merit regulator only going forward, so they're not going to be blocking new Bitcoin-backed securities, just based off of being anti-Bitcoin. As long as they follow the law and disclose everything, then those securities are going to get approved. And so I think that there's a tremendous sea change in terms of the amount of capital that's going to come into Bitcoin from TradFi, whether it's bond portfolios, equity portfolios, derivatives traders, right? The degens in TradFi, or the commercial banking system, and everything in between. So that's why I'm super bullish on this space, and I think that it's really the only way that you get to $1 million Bitcoin. You don't get to $1 million Bitcoin from people staying humble and stacking sats $20 at a time like I do, right? It's really from having massive institutional grade inflows.
The lead sponsor of this show is Bold, the best place to buy, sell, and save Bitcoin. For listeners in the US, Bold lets you secure your financial future with complete peace of mind by integrating a low-fee, Bitcoin-only brokerage with next-gen multi-sig vaults. With Bold, you can smash buy Bitcoin or set a DCA plan for only 0.99% fees and seamlessly deposit the Bitcoin direct to your Bold vault. The Bold Vault is a 2 of 3 collaborative multi-sig where you hold 2 keys and Bold holds 1 as a redundant backup, protecting against loss or theft. You can use Trezor, Ledger, or Coldcard hardware wallets to spin up a Bold Vault in just a few minutes, and the Bold Vault is the only collaborative custody vault available with 0 monthly fees. They're also offering 0 fees on your first $10,000 of Bitcoin buys and $25 of free Bitcoin when you buy $100 of Bitcoin or more. Try Bold today and upgrade your stacking experience over at getbold.io. And now, back to the show. Yeah, I think that's really well explained there. And I guess probably a common question, and I think you touched on this a little bit before, around the kind of not your keys, not your coins aspect. And I guess some Bitcoiners listening may think, is there a risk of system capture by the state here? Is there a risk that, a lot of the coins end up with Coinbase or something like this, and there's a centralized point that the state could try to capture the coins or something like that? What would you say to that kind of concern?
Yeah, it's interesting because it's the horseshoe theory that on the fiat side, the fiat bros are panicking because they're worried about the opposite happening, of Bitcoiners capturing the TradFi system. And I was just listening to the hearing where Brad Sherman, he was like, isn't all of this going to infect the fiat system with Bitcoin? It's a concern that clearly cuts both ways. So I think not, because I think that what happens is that in fact Bitcoiners do enter into positions of power, and that their interests are aligned with not seizing Bitcoin. Now, Are there going to be hard lessons learned? Yes, absolutely. Could Coinbase custody get hacked tomorrow, and then all of TradFi, BlackRock, they wake up in the morning, all their Bitcoin are gone, IBIT is destroyed? Sure, might happen. Is that a problem for Bitcoin? No, I don't think so at all. I think that what would happen in response to that is that Larry Fink would go on national TV and he'd say, you know what? Not your keys, not your Bitcoin. We're building our own custody solution. It's, oh, the government sees the Bitcoin. Okay, we're building a multi-jurisdictional multi-sig. Elon is building a satellite system of custody that is outside of any nation's jurisdiction. It's going to be in space. It's going to be in international waters. It's going to be at the bottom of the Mariana Trench. It's on the other side of the moon. So, Bitcoin's anti-fragile. Anything that attacks Bitcoin is going to cause an immune system response that is going to cause a decentralization of Bitcoin. Conversely, the better society is, the stronger our institutions are, the more stable our civilization is, the more centralized solutions can be, because that's more efficient, right? And so it's almost like if you want people to hold their own keys, then, and I'm not saying anybody should do this, but start cyber attacking Coinbase, right? You want to be a cypherpunk who, is decentralizing Bitcoin, then either you can complain on Twitter about TradFi and the financialization of Bitcoin and have zero effect on history, or you can become a cyber terrorist who attacks infrastructure in order to accelerate your chaotic future of a low trust society where people have to hold their own keys, because if they don't, their Bitcoin are going to get stolen from them. So it's very dystopian. I think that it's almost like the people who are warning about this outcome, part of them wants it to happen, right? They want to be the hero in this story, which I don't think that's healthy. I think you kind of just have to accept reality as it is and manage the risks, right? So, there is a risk that Coinbase screws up their key custody. I think that's a higher risk than those keys getting stolen by the government. I think there's insider threats, right? Maybe somebody working at Coinbase sees an opportunity to steal the Bitcoin for themselves, right? And maybe they get caught, but when they get caught, they destroy the keys or something. It's sure, lots of things could happen. An EMP attack, whatever. So yeah, I completely understand that we should be paranoid, but we also have to accept reality that there's lots of risks that are not going to manifest themselves and they're not going to materialize. And in fact, mainstream society is built on the premise that they're not going to materialize. So, if part of your risk management is prepping and all of this stuff, that's great. Is that going to go mainstream? In the absence of a catastrophe, no.
Yeah, interesting thoughts. And I think maybe it's like a psychological thing. Maybe people aren't ready to win, right? They're not used to winning. They don't realize if you are a Bitcoin holder now, especially if you have your own keys and you're self-custodying, you're winning right now, right? We're basically at all-time highs. Okay, yeah, we're a little dipped down, but whatever. I mean, you wait a bit more, I'm sure, things will be all right if you just wait it out. And I think I'm curious, is it a psychological thing? Are there just people out there who just have been so used to losing that they're not ready to just accept this victory?
I think that it's actually about their understanding of Bitcoin, where if I tell them, look, you can basically trust financial institutions, right? If you tell them that, then they immediately jump to, well, then what's the point of Bitcoin? Why do we have Bitcoin if people are just going to use third-party custody? There's no point to this whole experiment. We could have just stayed with the dollar. And that, I think, is where we really see the giant chasm between my monetary maximalism understanding of Bitcoin and their cypherpunk understanding of Bitcoin, where I think that Bitcoin is both, and that they're missing the fact that Bitcoin's monetary policy and the option to not trust a financial institution is inherently valuable. And so the fact that you can opt out is what holds these financial institutions accountable so that they are limited in their misbehavior. That is that if everybody is stuck inside of their walled garden, then yeah, they can do whatever they want and they will abuse their power. If people are free to exit, well, the whole game theory changes for them. And so it is a paradox that is, I think, challenging for folks to wrap their minds around, because they have this black and white either or view of it, of either we're all running a node, all holding our own keys, and all benefiting from the central premise of Bitcoin, or people are completely missing the point and we might as well stick with fiat. And I just don't think that's true at all. I think that there's a lot more nuance to it than that. And it really does come down to the freedom to exit. And in order for that freedom to be credible, yeah, we have to exercise it, right? Like we gotta run our own Lightning nodes. Yeah, we gotta have people who are actually building out the technology. You gotta buy a hardware wallet. I'd argue you gotta do both, right? At the very least, I recently saw my friend Gladiator on Twitter, who's been like a huge MicroStrategy bull. He used a hardware wallet for the first time, and like his eyes lit up and he was like, wow, this is really cool. So it's also the case that the financialization of Bitcoin is a top of the funnel marketing that is going to bring people to that cypherpunk ethos where they're doing both. They're both a Bitcoin maximalist and, also interested in trading options and all this stuff that is, anathema to cypherpunks, but, they're interested in it. So I think it's been really cool to see that evolution.
Yeah, and as you mentioned, I think that is the bigger on-ramp, arguably, right? It's not necessarily going to be the kind of the crypto world. I think the on-ramp for a lot of these people, especially nowadays, is going to be this TradFi world. I'm curious where you see kind of the stablecoins playing into that here. Like, do you see stablecoins also as an on-ramp or a stepping stone for some people? Or is that just like an orthogonal thing?
So I think that for folks who don't have a dollar bank account, that's a great option for them. Especially if it means that, if they're choosing between their local hyperinflationary currency that is permissioned with a terrible banking system, or dollar-backed stable coins where, they've got to trust the issuer, they got to trust Tether. But other than that, it's basically permissionless, right? They can create a wallet, they can send it back and forth. Now Tether's on Lightning, which is a really interesting development. Or they use Bitcoin, right? And I'd say, oh, wow, you should just use Bitcoin, right? It goes back to our conversation about volatility. Bitcoin is too volatile for them. And I think that they have to essentially, and this is advice I give to anyone, is like, before you start investing in Bitcoin, make sure you have some dollars in your emergency savings so that you don't have to go panic sell your Bitcoin if you lose your job or if you have to repair your car, etc. So what stablecoins allow is for people in foreign jurisdictions to develop their emergency savings, save up enough, and then it'll be really easy for them to flip from a stablecoin into Bitcoin, right? This is where I think DeFi makes sense. If you don't have access to a brokerage account, DeFi makes sense. If you don't have access to a banking account, stablecoins make sense. But it goes back to the fact that there's low trust jurisdictions where the products needed are very different than the products we need here in the United States. And then we get lots of miscommunication on Twitter over what's better, right?
Right. And I'm curious if you have a take on the whole surveillance aspect, because that seems to be a big kind of criticism. I sort of go back and forth on it. Obviously, I wish the government did not enforce surveillance, all that. But I'm curious your take on whether the concern, as best as I can understand it, seems to be, oh, you're building a surveillance system. by using these things. That's as I understand it. I'm curious how you see it.
Without a doubt, the existing traditional financial system is a financial panopticon. It is a mass surveillance system. It's a huge problem. I hope that Elon Musk and Doge and kind of the new wave of liberty-minded politicians take a look at it and dismantle it. Or that the Supreme Court dismantles it, because it does violate the Fourth Amendment. So the Bank Secrecy Act has to go. It is a gross violation of human rights. Now, should we be is that the problem that Bitcoin solves? To some extent, yes. Go look at the Satoshi Nakamoto's white paper. He explains how Bitcoin's privacy model is arguably better than the traditional financial system because it's pseudonymous, even though it's public. And so there's that. Now, does it completely fix things? No, because we've seen the emergence of Chainalysis and all of this stuff. Is Lightning a lot better? Yes. It still has trade-offs, right? There's still privacy concerns within Lightning. But is it kind of like the biggest problem that currently faces humanity? I don't think so. I think fix the money, fix the world. And it goes back to kind of changing the game theory and the incentives. I think in a hyper-Bitcoinized world, all of this surveillance stuff, the anti-money laundering stuff, it just kind of becomes irrelevant. These people just become weirdo peeping Toms. They're not really weaponizing this information to go after people. So that I think, it's something that we need to work on to get all the exchanges to delete their databases, delete their KYC information, delete all of the. So I'm all board with that. Now, is there an opcode, a new opcode that's going to magically fix all of this? No, there isn't. There's cool opcodes, without a doubt. Some of them are more interesting than others. There's no silver bullet for fixing privacy. And, in particular, it's you'll hear people who talk about Monero and Zcash, and they're buying it at Kraken, where they're fully KYC'd. And it's I'm scratching my head of what are we? So there's just very bizarre. It's almost like just S-coin narratives that spin out of control. But most of the privacy problems I've seen are self-inflicted, right? Of people reusing addresses and not really thinking about UTXO management. So yeah, I struggle with that question myself, of how big of an issue it is, because I like to do a lot of statistical analysis of Bitcoin. So I'll look at, okay, Bitcoin network had more than $10 trillion of activity over the past year, and somebody will ask me, what was that activity? I have no idea. I asked Chainalysis, what was that activity? They have no idea. They know that less than 1% of it was criminal activity, but they don't know what the 99% was. So I'm there's no.
It's not as objective.
It's bizarre to me, right?
Or it's kind of not reproducible, and there are, I guess, concerns around that. But yeah, I think it's to the point you were making. I agree that the primary thing Bitcoin is fixing is government control of money, right? If we just change that, then I think some of the surveillance considerations, whether that's Bitcoin or with stablecoins, I think those things are likely to be, they could be fixed on L2s or other layers, but also maybe that's not the primary problem. I think, that's how I'm seeing it.
And then also it always, I found on social media, it comes from the Monero people. Monero had a bug in it that caused it to be de-anonymized years back. So that's where I'm okay, you can come up with your privacy solution, but should you rely on it? Probably not, because it might get de-anonymized in the future. So even from that perspective, it's like kind of dodgy to say, oh, I'm going to build, my whole darknet drug market on Monero under the premise that it will always be anonymous. That's, a
dubious,
huge assumption. I don't think that's a good idea. And more likely, the government will seize your hard drive or whatever, and like they'll have the whole database.
Unwind all the transactions from that, right?
Yeah,
because they'll have your key, your viewing key or whatever.
They're not doing on-chain tracing for it. Yeah.
Yeah, so I think fundamentally it's about, I guess, having the right understanding of Bitcoin, like understanding what problem does it solve, how does the system actually work to, let's say, defend itself or remain viable, even if certain individuals or certain companies get wrecked or get hacked or something. What happens at the system level? And I think that's the important thing. So I guess summarizing some of the key points, we've spoken about this idea of securitization or financialization of Bitcoin as opposed to the, let's say, tokenization, this kind of crypto DeFi world. And sure, this crypto DeFi world will still exist. It'll still be there. But I think the main show really to watch is Bitcoin adoption and Bitcoin securitization, isn't it?
I think so. And I think that's what's going to drive the speculative attack, where people are going to be borrowing dollars to buy Bitcoin and then paying off those dollar-denominated loans using the gains that they got from Bitcoin. And it shows that, the central critique of TradFi, of Bitcoin, was always that Bitcoin does not have any cash flows. And that is categorically false. Bitcoin has a cash outflow when you buy it, and then it has a cash inflow when you sell it, right? So, if you're thinking about it from a fiat perspective. And, that's all you need to have a business. And so I think that's been something that has confounded the critics over the years.
Fantastic. Well, look, I think that's probably a good spot to finish up there. Any last thought, any closing takeaway for people?
I'm not providing any financial advice in this episode. There's definitely the necessity of looking at all those SEC filings, right? The SEC is very good at making sure that everything's disclosed and transparent, whereas maybe in some tokenomic white papers, they're not held to the same standards. So do your own research. And not your keys, not your Bitcoin, obviously. And I think that we got to stay humble and stack sats. That's while also being realistic about what is going on in the wider world outside of our echo chamber on Twitter. So you can find me on Twitter at Bitcoin Pierre. I'm always looking at both sides, right, looking at the TradFi system and then looking on the Bitcoin side of the system, and always looking to find insights there. So follow me on Twitter, and happy to take questions as well. My DMs are open, and thanks for having me on, Stephan. This was a great conversation.
Excellent. Well, thank you for joining me, Pierre. And follow listeners. Make sure you go and check out Pierre's work online. All the links in the show notes. Thank you, Pierre.
Thank you.